Hey everyone, welcome back to the channel. I'm Doug, the retirement guy, with all your monthly ETFs. Today we're going to break down simplified SPUC versus the Goldman Sachs GPIX. I'm going to put it as which S&P 500 income is better for retirement, but there's a reason why I'm putting these two up against each other. SPUC has made some changes. And it's some significant changes. And I think they're going to become a player in the S&P 500 market, which would be perfect for the retirees who are not all into the NEOS packages or the Goldman Sachs packages, that we have a new player coming on the scene. And we're going to break it down today, explain it all to you. So grab your mug, pour your favorite drink into it, sit back, and let's learn a little bit about the S&P 500 income ETFs. Important disclaimer, this content is for educational and entertainment purposes only. This is not financial advice. Past performances do not guarantee future results. So let's take a look at these two funds here. SPUC from Simplify has been posting an advertised 11.74% distribution rate. Well, it's right up there with the big boys like SPYI from NEOS. Now, GPIX is an 8.75 targeting yield. So we can see it leaning more towards, Simplify. Monthly estimates, like I said, is between 48 and 49 cents per share versus 35 to 40 cents a share. So on a $100,000 income, you're looking at more $11,740 a year or $978 a month versus the $8,500 to $708. So there's some differences there. Expense ratios. Simplify is right in that 0.53 category of expense versus the long short-term holding of GPIX at 0.29. Now this fund came out in September of 2020. So why has it not been a player out there? Because of June 29th mandated change that they did. And we're going to talk about that and explain it to you. Versus the launching of October 2023. So they've had a consistent premium mandated. They have a system that they use. And we all know GPIX definitely a strong player. And I always call it an income bucket core, while SPUC is really targeting to me as a high income satellite, which is another big positive why I said it's time to do a little bit of research on this program. So SPUC, the strategy is IVV plus active long and short options. SPC combines the core position of IVV, which is the iShares Core S&P 500 ETF, with an actively managed long and short option overlay to seek enhancements and long-term growth potential. So basically they're taking the core holding of IVV, and some of them use SPYI, some use VOO. There's just different ones out there to use. Active long and short option overlays, actively selected long and short options to generate that premium and manage risk that we're looking for. So they're looking for the calls, they're looking for the puts, they're looking across the board trying to gather up as much as they possibly can. And with the active management, the experienced team adapts to the market conditions and opportunity, which gives us our income potential. Now, 99.6% of the portfolio is in the exposure of the IVV. Now, their expense ratios we talked about, 0.53, right in the middle of the game plan. But this one is built for market participation with active enhancements that they've chose to put into this. So what the whole package is, they're trying to do 500 S&P 500 exposure, discipline active strategies, risk management, and they're hoping to get income and growth potential. Now, here's what the big thing is, and here's number of reasons why I sat down and said, I got to read into this, do the research, so I can put this out on the channel. There was a mandated change that went into effect June 29th of 2026. It's a strategic pivot from what they were doing. SPUC shifted from a growth-focused objective to a tax-efficient monthly income mandate. So the historical content, the 3-year and 5-year track records reflect the prior growth strategies, not income. So when you start looking long term in these things, you got to start scratching your head. Hold it. We were doing growth first, and now we're going to income. So the past 3 to 5 years, we almost literally, I can't say throw out, but you got to remember, totally different operations. So I really got to tell you, this whole thing is limited operating record to revise the income mandate has a very limited time in history that reflects that significant future change. And then the active monitoring phase, investors should monitor distribution coverage the NAV for another 4 to 8 quarters. So what I'm saying here is we need to have a little more time to make sure if we call this one strong, another big player in that S&P 500 core market, we're going to need some time to prove, because I'm looking at this, even though the advertisement of a 6-year-old fund, but it's a 6-year-old fund that just changed its way of doing business. So I call it a very new fund. So this thing, like I said, September 20th, it launched. June 20th, 26, it changed its mandate. We're now reporting it here in August. So we got basically, 30 days under its belt. What's going to happen afterwards? That's what we're really concerned about. Now, GPIX, we've talked about this on the channel many a times. It's one of my favorites out there. I personally own it in my portfolios. I do use it as a satellite, not my core, just being honest with people. But I believe GPIX is actually a core portfolio structure. It's got the broad diversity of the equity portfolio designed to resemble the 500. Unlike traditional funds, it doesn't normally cover that 100% of the portfolio. It uses that flexibility, or that flex investing, that is realistically probably between that 25 to 75% across the board, basing on the market structure of what's happening. So when the market is having a strong run, they'll only cover 25%. When it's in a high volatility or a drop off, they'll pull it back to 75%, trying to generate more income. So this dynamic partial coverage leaves room for actual natural growth in the fund. This is why you'll see yields being lower, but growth overall being higher. When we take a look at what I did here is explain people is in June, the average coverage was 35.85%. Okay, if we go back for the average coverage now, it's about 33%. So you can see they don't cover a lot to get that 8-9% income. The fund came out in 2023 and it has an expense ratio of only 0.29. Why expense ratios mean so much is if you're going to carry these for long hauls, and when I say long hauls, 2, 3, 4, 5 years down the road, it's only costing you $29 on a $10,000 investment, while the other one's costing you $53 on that same investment. So realistically, both are good, but this is just a much lower cost down the road. Now, the strategy trade-offs, the new engine versus the proven coverage. The active part of SPUC is that 99.6% of IVV core plus active long and short option overlays. I do like the long and short overlays. Don't get me wrong. I do really appreciate that. It creates a higher annualized distribution rate, 11.74. But this, again, the system is still brand new. I gotta call it brand new for a 6-year-old fund. It's still going to be brand new. While GPIX, overall, my personal opinion on this is I like the 25-75 swing, that optional coverage that they do, is because they're doing it to a market versus other funds that set it, forget it, or set it at the beginning of the day and change it, or at the end of the week, however you want to play to it. Both of these use a different strategy in the package. I personally put GPIX as the winner. It has a lower expense ratio. It has a greater scale to target the marketing. And it's a proven mandate consistency that they've had. It's been proven for the 3 years that they've operated so far. I really put more eggs into that basket than I do, and I'm not saying their system is wrong or different. It's just proven to me to be better in GPIX. Now the higher payoff. Now if we were chasing yield, and you know on this channel I don't chase yield. I want to take a look at yield's important, but I want to look at the growth. I want to see the total returns, because yield is just a number. Yield can change. If the stock market was on, and if the price goes up, your yield's going to go down. If the field price goes down, the yield's going to go up. But we really got to take a look at these two. 11.74 is a very, very strong number. The question is, can it continue to do that, and can it hold the growth side of it to keep those numbers there? While GPIX has already proven this at 8.5. So picking up basically, 3.25 percentage points is huge in most people's portfolios. But I also got to say, it's security and safety we have to look at. So I'm not giving the award. I'm going to give SPUC the yield award, that they win that yield, but we got to keep digging deeper and make sure both of these are very strong pieces of the puzzle and where we can fit it. Let's take a look at the growth. Now, GPIX has had lately, since April, a stronger total growth across the board, while SPUC had a bigger drop off in April. So when you take a look at the chart, and why I did this big chart is we can look all the way back. In August of 25, this is where you see the blue line where they had huge growth, beating out the S&P 500 across the board. Then it had its drop off come January, and you can see where they were struggling all the way through. Now we're going to look at June of 2026 and start to see the patterns are identical to each other. Okay, so my question would come into right off the bat, what happened in January? Why did we have the massive drop off in January that the market really didn't show? The rest of it I can explain. That was really designed for growth. Did they actually start to challenge and change things back in January with the mandate that had to play into effect in June? I did not find any facts on that as yet, but I'm questioning that very strongly, because once you start looking, take out that January mark, these things start almost following each other, tooth by tooth by tooth by tooth, all the way through. And you can see that SPUC did drop off a little bit more. So their system does not grow as quick, so it's not going to recover as quick. It's not going to come back as quick. But the gap between January 2026 and today is virtually almost identical to each other. So again, both of them following growth equal ways, following income two different ways, but our price change 9% versus 5%. So we're going back to the old argument, and I probably need to do this SPUC against SPYI to verify those two. But you can see where GPIX, Goldman Sachs, definitely have a better growth package, and we would expect that. Better growth, smaller yield. This one has smaller growth, better yield. Now GPIX, I just want to show you this one. GPIX, the relative evidence that they have done very, very well. Since the launch in 2023, GPIX has shown a healthy balance between generating monthly income and maintaining portfolio growth. Okay, the portfolio health evaluation of the income ETFs must include both cash paid and remaining NAV health. GPIX record shows it can generate income without depleting principal. Now, SUPC's historic success can't be used directly for proof of this. So I really couldn't prove apple for apple just under the last 30 days. But I wanted to show people why GPIX is such a strong player. They've had NAV appreciation of over 37% since inception, and I did this through June 30th because I didn't have all the data for July, didn't close out in time. But I wanted to put this together for a NAV of June, 37%. Okay, their total return has been 64%. Okay, and the yellow is going to be your income of 26%. So you can see that it's been solidly two solid blocks across the board. This is why when people ask me, I want a little bit more conservative, I want more balance, GPIX goes into place. Also, why I personally use it as a satellite. It's a nice balance between the two. Could you use it as a core? Most definitely. So total return, the draw on the performance. I'm calling this a draw for a particular reason. Now, year to date, 99.91% for GPIX, 8.95% for SPUC. So we're basically a 1 percentage points off between the two. When we go into total 1 year, though, 22.59 to 21.49, you're trading that 1% back over when we've gotten 12 months under the hood. Here's my problem. We're using some of SPUC's old strategy to the new strategy, while we're using GPIX's strategy from the start of the beginning. So even though these two are so closely compared, I'm heavily watching the year-to-date package to see what's going on, because the new mandated structure change has only been 30 days old. Did that cost the 1%? Is that going to cost us more down the road? So even though it's today doing this, it is a tie, but I really got to tell you, we got to keep focused heavily on these two programs. The costs, like I told you before, if you were, you do it with $100,000, you do it with $10,000, just add a zero either way. Overall handling costs, if you're going to hold these things for long periods of time, I've told you many times before, the pricing that you see, the yields, the growth, and all that, I'm going to have all this stuff included into it. Total returns will have this into it. But what the real answer comes into is, are you going to hold this for long periods of time? This is when the growth becomes, or the expense ratios become very, very critical if you're carrying for a long time. In retirement, yeah, we're going to carry these things for probably 5, 10, 20, 30 years down the road. So you're going to have a little bit more savings in the Goldman Sachs. So they are classified as the winner. But you want to make sure you're staying in that, basically, I'll call it 0.75% or less is really the magic curve. I always like to be below 3.75 for long-term holdings. Get above that, man, then it's very expensive to carry. It's got to perform a lot more. And this is the other side I say, why I'm happy with 5.3, I'll say I'm happy with 0.53. It's a fair number. But what it also says is they have to do almost twice as much. They got to pull more work. So SPUC better be pulling more income or more growth or something to help make up for that cost difference. Now, here's another big one that comes into it, is the tax side of it. Now, this is almost, again, why I said I should almost compare NEOS to the simplified package, is because SPUC is now using those Section 1256 potential because they're into that index option classification. It may qualify for the 1256, offering that blend of taxes regarding the holding periods. We've talked about that, the 60-40 rule, the 60% long-term, 40% short-term, using 1256. They do use the tax loss harvesting, and they've also reported that they will be planning on using the ROC as needed. So very, very similar system that NEOS uses across the board. While GPIX still uses the tax deferring strategy of return of capital and the natural classification across with I'll show you here, is in 2025, the actual ROC they used was 87.53%. Currently, as of now, they're 91 to 92%, but remember, none of that means nothing until you get your 1099 DIV. That 87% was actually the DIV that I got from 2025, so we know that we are talking about they'll probably be up a higher number. Where do I put it? Well, it's going to come down to is where you're putting your money at. If you're putting your money into a taxable brokerage account, now most retirees will be in a tax brokerable account as you go. You normally will set up a tax brokerable account to where you're pulling your 401k over, or your IRAs need to come into things, or you're going to pull your distributions into something. You're going to pull them in the brokerage. So SPUC has that potential edge over GPIX. Okay. So it is going to be leaning more towards using that one instead for tax purposes. In an IRA and a Roth, it's virtually tied. They have to follow the rules of the IRA or the Roth. They have to follow that completely. So realistically, the tax side of it, I'm going to give them both really a close tie, leaning a little bit more to the SPUC because it's very similar to the NEOS package, which I just like better in a brokerage fund. So our retirement scoreboard comes this way. The headline distribution, well, yield, SPUC is going to win that one. This one here, though, strategy evidence with a limited record, I got to give it to GPIX across the board. The NAV growth, the growth of the fund, again, very hard to compare the two. I'm actually going with GPIX as the winner because it's just a brand new strategy. I don't want to use old technology with a new technology and say it's going to happen the same way. It's the wording I always tell you guys at the beginning of the show. Past performances don't guarantee future results. This is prime example of that. Expense ratios, man, I'll tell you what, you can't beat GPIX for expense ratios. Total returns, we said that was a draw across the board. There's a 1% for year to date, and there's a 1% for 1 year out, going both sides of the fence. Taxability for sure goes to SPUC, and if you're into a Roth IRA or a standard IRA or 401k, do it that way. So where do we also put this stuff into? The safety bucket of the cash and treasury and liquidity. Neither fund replaces anything that we go into our foundation funds. Okay, income bucket. Realistically, if these two were the use that you were choosing between, I have to go with GPIX as the potential core holding, with SPUC as my satellite holding to boost the income, while the GPIX gives you the balanced approach of both of them. Now, both of these, I can argue this one both ways. The growth bucket, that inflation fighter, I like the core S&P 500 package and exposure to it. But overall, I don't know if I'd put either one of these two in my growth bucket. There's other better funds that are out there for that. If you said, no, I want this in my growth bucket, I can't argue with you. If you're rolling and dripping the yield back into it as more and more growth, so that you're looking at your true hardcore total returns. But here's where I tell you the satellite sleeve, it's the controlling that yield boost. It's really putting SPUC as a booster to the income. And that's why I think these two together are almost maybe the magic little package. And switching it, GPIX is your core. You get the growth, to help you with the inflation, grow the fund with 8.5% income that you can live from comfortably. You let SPUC do its job to generate that 11%. And you're probably going to boost your thing up to probably right around that 10, I'd put it probably close to a 10% total return from your income bucket. So very strong numbers when we talk about that. So my cold verdict, pretty much already gave you the answer on this one. GPIX is my core winner. And the mandate change, I put this as satellite. This could ultimately be a core winner down the road. Once we see more of what's happening with that mandated change, is it really going to work? Is it really going to fall into play? I believe they're just copying the whole game plan of what NEOS is doing, which is not I hate to say, not dumb. It's not a dumb piece. I think it's a very strong piece to do. But I just want to say this, that mandate changes the game plan of what we're talking about. So let me know your thoughts. Leave a comment down below. Do you own SPUC? Did you know about the change coming to it? Or are you a GPIX fan? Or are you a NEOS fan? I'd love to hear from you guys down below. What do you think of SPUC as well? If you like what we're doing, hit that like button. That helps the channel the most. And I look forward to hearing you into the future.